Here is a sentence that sounds like a conspiracy theory. Some of the richest people alive can go years without a taxable paycheck while still spending millions. It is not a conspiracy. There is no secret law written for them. There is one public tax code and a completely different relationship with it. Most people are taught one way to handle money: earn it, pay tax on it, spend some, save what is left. The wealthiest people play a different game, not because they found a secret loophole, but because most of their wealth doesn't arrive as a paycheck. It arrives as ownership. Shares in companies, real estate, private businesses, intellectual property. Assets that can rise in value without producing a salary slip every month. And once money becomes an asset, three things change: when tax is triggered, how cash can be accessed, and which risks become worth taking. Joe discovered this on a Wednesday night. He had opened an article about how wealthy founders finance their lives without constantly selling stock. One article became 5 became 20. By midnight, his desk was covered in notes, and one question was circled 3 times. So Joe organized everything he found into 5 ideas. Not 5 magic tricks, not 5 shortcuts to becoming rich. 5 ways that ownership changes the relationship between income, tax, risk, and time. For each one, we're going to answer 3 questions. How does it work? What can go wrong? And what, if anything, can an ordinary person actually use? Start with the strategy that sounds most like free money. It is not free. Imagine you own stock worth $10 million. You bought it years ago for $1 million. If you sell it, that $9 million gain may trigger tax. But if a lender accepts that stock as collateral, you may be able to borrow cash without selling it at all. The loan gives you liquidity. The asset stays invested. And borrowed money is generally not treated as income because it has to be repaid. That is the engine behind the phrase you may have heard before: buy, borrow, die. Buy appreciating assets. Borrow against them instead of selling. And under current United States rules, some inherited assets may receive a new tax basis at death, potentially reducing the taxable gain that accumulated during the original owner's life. Say that phrase again, slower, because this is the part viral videos leave out. A loan is not a tax deduction. It is a debt. Interest must be paid. Rates can change. The collateral can fall in value. And if it falls far enough, the lender can demand more collateral or sell the assets at the worst possible moment. Even the interest is not automatically deductible. That depends on what the borrowed money is used for and on the rules that apply to the borrower. Joe wrote one sentence beneath the strategy: borrowing can delay a sale. It cannot eliminate risk. So what can Joe actually use? Not a giant securities-backed loan. He doesn't have the portfolio, the lending terms, nor the risk capacity for that. But he can take the deeper lesson. Wealthy people build assets first and solve liquidity second. Many people assume selling is the only way to turn an asset into usable cash. Wealthy investors ask whether selling is truly necessary and carefully calculate the cost and risk of every available alternative. The second idea looked simple in Joe's notes. Who owns an asset can change how that asset is treated. A business can own equipment, vehicles, property, software, or intellectual property. If those assets are genuinely used to produce business income, qualifying costs may be deductible. That structure can also separate operations,
simplify investment, create continuity, and make ownership easier to transfer. But here is the line that matters. A company is not a costume you put on a personal expense. Calling a family holiday a business retreat does not make it one. Putting a personal car in a company does not make every journey deductible. Personal use can create taxable income, disallowed expenses, reporting obligations, and penalties.
Wealthy individuals and families often use legal entities, but sophisticated planning is valuable precisely because the rules are real, not because the rules disappear. Joe crossed out the phrase, "own nothing, control everything." It sounded powerful. It was also too easy to misunderstand. He replaced it with something better. Own deliberately. Document honestly. Separate everything. For Joe, that means starting small. If a side project becomes a real business, he can keep separate records, separate accounts, and a clear line between business and personal spending. Then, Joe can ask a qualified professional whether a sole proprietorship, limited company, corporation, or another structure fits his country and circumstances. The lesson is not put everything in a company. The lesson is that structure follows purpose, and bad structure creates costs instead of saving money. The third strategy was the first one Joe could imagine using himself. Suppose one investment gained $50,000, while another lost $20,000. If the losing investment is sold, that realized loss may offset part of the realized gain, subject to the applicable tax rules and limitations. The investor's net realized capital gain may fall from $50,000 to $30,000. That is tax loss harvesting. At scale, investment teams monitor portfolios for opportunities to capture losses while preserving the investor's long-term allocation. But the loss is not imaginary. The investment really declined. And the benefit may be a tax deferral, not a permanent elimination of tax. There is another catch. In the United States, wash sale rules can disallow a loss if the investor buys the same or a substantially identical security within the restricted period around the sale. So a careless sell and buyback can quietly destroy the exact benefit you were trying to capture. Joe reduced the entire idea to 3 steps. First, review realized gains and unrealized losses before year-end. Second, decide whether selling still makes investment sense after considering fees, taxes, and portfolio changes. Third, check the local replacement and timing rules before trading. The tax decision must serve the investment plan, not replace it. A tax saving can never rescue a bad investment decision. The fourth idea was charity, but not the cynical version Joe first found online. Suppose an investor owns shares purchased for $10,000 that are now worth $100,000. Selling the shares may create a taxable gain, but donating qualifying appreciated shares directly to an eligible charity may avoid that sale by the donor. The donor may also qualify for a charitable deduction, subject to valuation, holding period, income, and other limitations. The charity can then use the full donated asset to support its mission. For someone who already intends to give, donating the right asset can be more tax efficient than selling it, paying the tax, and donating the remaining cash. Wealthy families may also create private foundations or use donor-advised funds to organize long-term giving. These structures can influence which causes receive support and when grants are made. But donated assets are not a private checking account. Private foundations face rules against self-dealing. Family members may be paid only for legitimate, necessary work at reasonable compensation. Money dedicated to charity must serve charitable purposes, not the donor's personal lifestyle. Joe's revised note said,
Strategic charity is still charity. The mission has to be real.
What can Joe use? If he already gives to charity and one day owns appreciated investments, he can ask whether donating the asset directly would be more efficient than selling it first. But he should never donate merely to save tax. Spending $1 to avoid paying a fraction of a dollar does not make him richer. Give because the cause matters. Then structure the gift so more value reaches that cause. The fifth strategy was the least glamorous and the most useful. Wealthy people do not usually treat cash as the finish line. Cash is liquidity, optionality, protection, and raw material for the next investment.
Too little cash can force someone to sell an asset during an emergency. But too much idle cash can quietly lose purchasing power because of inflation. The goal is not to have zero cash. The goal is to hold cash intentionally. Money needed soon belongs somewhere safe and accessible. Emergency reserves protect the financial plan. Tax reserves cover future obligations. Short-term savings fund known expenses. Only after those jobs are covered should long-term money be directed toward long-term assets. These could include diversified investments, a carefully evaluated business, useful education, intellectual property, or other assets capable of producing income or increasing in value. Joe opened his banking app. For the first time, he didn't see one number called savings. He saw 4 separate jobs: emergency, short-term, tax, investment. The amount hadn't changed. The purpose had. And money with a purpose is much harder to waste. Joe finished at 1 in the morning with more pages of notes than he wanted to admit. He was not a billionaire. He didn't have a private banker or a tax team or $10 million in stock. But he no longer believed the only 2 choices were to copy billionaires or learn nothing from them. So Joe created a 30-day plan. First, he separated his emergency savings from his investment money. Second, he calculated his current asset allocation and automated a modest monthly contribution. Third, he opened a separate account for his side income and started keeping proper records. Fourth, he scheduled a year-end portfolio review instead of making random tax-motivated trades. Fifth, he wrote down the questions he would ask a qualified tax professional before making any decision involving debt, business entities, or charitable assets. None of this made him rich overnight. That was the point. Real wealth is usually built by systems that look boring before they look powerful.
Here is what Joe finally understood. The wealthy do not operate under a completely separate tax code, but they often earn, own, borrow, give, and invest in ways that interact differently with the same code. Income can trigger tax now. Appreciation may defer tax until an asset is sold. Borrowing can create cash without creating income, but it also creates debt and risk. Losses may offset gains, but only when the applicable rules are followed. Charitable giving can be tax efficient, but the donated assets must truly serve charity. Business entities can organize ownership, but they cannot transform personal spending into legitimate business spending.
And cash is valuable, but only when its job is clear. The real advantage was never one secret loophole. It was the habit of asking better questions before money moved. What am I buying? What will trigger tax? What risk am I accepting? What structure matches the real purpose? And what happens if the plan goes wrong? Joe didn't find a secret door that Wednesday night. He found a set of instructions written in complicated language, and finally translated them into decisions he could use. That is where financial change
actually begins.
Financial change doesn't begin when you copy the life of someone with $1 billion. It begins when you start treating every dollar you have with intention. So, which strategy changed the way you think about money? Number 1, borrowing against assets. Number 2, choosing the right structure. Number 3, tax loss harvesting. Number 4, donating appreciated assets. Or number 5, giving every dollar a job. Drop the number in the comments and tell me what surprised you.
In the next video, Joe takes strategy number 5 and builds a real 4-bucket money system from scratch: emergency, short-term, tax, and investment. No billionaire income is required. Subscribe, because understanding the rules matters, but building a system you can actually follow matters even more.